So you've got some money saved up, and it's just sitting in a bank account. Have you ever wondered what's next? Well, you are in exactly the right place. We are about to map out the entire world of investment options, from the absolute safest to the really complex stuff. Let's dive in. Look, having money in the bank is a fantastic start, but the real question is, where does it go from there? Think of this as a roadmap, a guided tour for your money. We're going to explore all the ways you can put that money to work for you. To make sense of all this, we're going to use a simple idea, the investment ladder. We'll start at the bottom on the safest rung, and with each step we take up that ladder, we'll look at things that have a little more risk, and yeah, maybe a lot more potential for reward. All right, first things first. Part 1, the low-risk starting points. This is the bedrock, the solid ground that everything else is built on. These are the kinds of places to put your money that you're probably already familiar with. Okay, non-marketable financial assets. That sounds super technical, right? But the idea is actually really simple. It's basically any deal that's just between you and an institution, like your bank. You can't just turn around and sell your savings account to your buddy. It's a direct agreement that's not transferable. And I bet you already know exactly what these are. Your everyday savings account, certificates of deposit, CDs, and money market accounts. The big thing they all have in common, they're super liquid. And that's just a fancy way of saying you can get your cash out easily and quickly. So here is the key difference you've got to get. Non-marketable means it's a closed loop, just you and the bank. But marketable, that opens up a whole new world. It means you own something you can actually sell to other people in a marketplace. Understanding this one idea is the key that unlocks the rest of the ladder. Our first little step into that marketable world is with money market securities. You can think of these as super safe short-term loans you're making to governments or big, stable companies. The big difference is you can trade these with other investors, but they're still so stable that we consider them a foundational, low-risk asset. Time to climb. We're headed up to the next rung on our ladder, lending with bonds. Now we're moving beyond just parking our money and into the world of actively lending it out to huge organizations like governments and corporations. This is where it starts to get pretty interesting. So what in the world is a bond? Honestly, it's just a fancy IOU. You lend your money to, say, a company or a government, and in return, they give you a piece of paper that promises two things. One, they'll pay you regular interest, and two, they'll give you your original loan back when the time is up. And this is exactly why you hear the term fixed income. It's not a mystery. If you bought a $1,000 bond like the one you see here, you know exactly what you're getting. You'd get that $50 every year like clockwork. Then, at the very end, boom, you get your original $1,000 back. It's a predictable, fixed stream of income. But of course, not every IOU is created equal, right? Some borrowers are more reliable than others. That's why bonds get a grade, kind of like a report card. Investment-grade bonds are from the A students. They're considered very safe. Speculative bonds, they're a bit riskier, but to get you to take that risk, they have to offer you a higher interest rate. So, who's doing all this borrowing? Well, it's the big players. You've got the federal government with its treasury bonds, cities and states raising money for things like schools, and of course, big corporations funding their growth. Okay, get ready for a big jump up the ladder. We're moving on to part 3. We're not just lending money anymore. Now we're talking about becoming an owner. We're talking about stocks. A stock is a totally different ballgame from a bond. When you buy a stock, you're not a lender. You're an owner. You get a tiny slice of the entire company pie, and that means your potential isn't capped. If the company does well, so can you. And it also comes with something called limited liability, which is just a safe way of saying the absolute most you can ever lose is what you put in. Now, stocks generally come in 2 flavors. Common stockholders are the real owners. They get to vote on how the company is run, and they get what's left of the profits after everyone else gets paid. Preferred stockholders are a bit different. They usually don't get a vote, but they get a fixed payment, and they're first in line to get their money if the company runs into trouble. You're going to hear a few key terms thrown around. Dividends are awesome. They're your share of the profits paid out in cash. The PE ratio is like a quick price check. It helps you see if a stock is expensive or cheap compared to its earnings. And a stock split, that's mostly a cosmetic thing. It just creates more shares to bring the price down, making it feel a little more accessible. And here we are, the top of the ladder, the advanced frontier.
Now, these are complex tools. They're typically used by professional investors for very specific reasons, so let's take a quick peek. At the very top, we find derivatives. And you know what? The name itself gives you a huge clue. A derivative's value is literally derived from something else. That something else, like a stock, is called the underlying asset. Its price moves, and the derivative's price moves with it.
The two most common types are options. A call option is basically a bet that a stock's price is going to go up. It gives you the right to buy it later at today's price. A put option is the opposite. It's a bet the price will go down, giving you the right to sell at today's price later on. The key word in all of this is right, not obligation. You don't have to do it.
So let's be super clear. These are not your typical starting investments. Derivatives are complex, powerful tools used by the pros for two big reasons. Either to protect their investments from risk, that's called hedging, or to make some pretty high-stakes bets on which way the market is going to move. And there you have it, from the solid foundation of a savings account all the way up through lending with bonds, owning a piece of a company with stocks, and even a glimpse at the advanced world of derivatives. We've laid out the map. We've climbed the ladder. Now the only question is, where will your financial journey take you next?